Struggling to understand price charts? You're not alone. In this video, I'll break down key technical analysis concepts so you can read any chart with confidence and make smarter trading decisions. So you don't miss future trading content. Support and resistance, meaning that neither buyers nor sellers have full control. Every time price reaches the resistance level, sellers step in and push it back down. Every time price reaches the support level, buyers step in and push it back up. At one point, price reaches the support level again, but instead of breaking lower, a hammer candlestick pattern forms. This is a strong, bullish reversal signal, indicating that sellers tried to push the market lower but failed, and buyers are starting to take control. Since we are in a range, the appearance of a hammer at support suggests that the market is likely to bounce back up toward resistance. Until a breakout happens, the market is expected to stay inside this range. By combining market structure, support and resistance, and candlestick patterns, we can easily understand what's happening and anticipate the next move, even in a sideways market. This shows the power of technical analysis. With just a few simple concepts, you can analyze any chart, understand the market's behavior, and predict potential price movements with confidence. Now, let's move to an important part of chart analysis: chart patterns. These patterns help us understand market behavior and predict possible price movements. But don't worry, we're not going to cover every single pattern out there. You don't need to memorize 100 different formations. We'll focus only on the most important and effective ones that actually matter. Okay, the first one is the double top, a simple but powerful reversal pattern. The double top is one of the most effective and easy to spot reversal patterns in trading. It signals that an uptrend may be coming to an end and a potential move to the downside is likely. This pattern forms when price attempts to break a resistance level twice but fails both times. This failure shows that buyers are losing momentum and sellers are stepping in to push prices down. A valid double top consists of three key parts. First peak, price moves up and hits a resistance level. Pull back, price drops slightly but then makes another attempt to go higher. Second peak, price reaches the same resistance level but fails to break through, showing weakness. When price breaks below the low between the two peaks, the pattern is confirmed and a downtrend is likely to follow. This pattern is most effective when it forms at a strong resistance level and after a clear uptrend. It signals that buyers have tried twice to push price higher but failed, which can lead to a trend reversal. Now, let's move on to the double bottom, which is the exact opposite of the double top. The double bottom is the opposite of the double top and signals a potential reversal from a downtrend to an uptrend. It's a powerful pattern that shows sellers are losing control and buyers are stepping in to push prices higher. This pattern forms when price attempts to break a support level twice but fails both times. This failure indicates that sellers are running out of strength and buyers are gaining momentum. A valid double bottom has three key parts. First, low, price moves down and hits a support level. Pullback, price bounces up but then comes back down for another test. Second low, price reaches the same support level but fails to break below, showing that sellers are weakening. When price breaks above the high between the two lows, the pattern is confirmed and an uptrend is likely to follow. A double bottom is most effective when it forms at a strong support level and after a clear downtrend. It signals that sellers have tried twice to push price lower but failed, leading to a possible trend reversal. The triple top is a strong bearish reversal pattern that signals a potential shift from an uptrend to a downtrend. It's similar to the double top, but instead of two peaks, the market forms three peaks at the same resistance level before reversing. This shows that buyers have tried multiple times to push the price higher but failed, indicating weakness and a possible move downward. A valid triple top consists of four key parts. First peak, price moves up and hits a resistance level. Pullback, price drops slightly but then attempts to go higher again. Second peak, price reaches the same resistance level but fails to break through. Third peak, price makes one final attempt to break higher but fails again, confirming seller dominance. Once price breaks below the low between the three peaks, the pattern is confirmed and a downtrend is likely to follow. A triple top is most effective when it forms at a strong resistance level after a clear uptrend. It signals that buyers have exhausted their strength and sellers are taking over. The triple bottom is the opposite of the triple top and signals a potential reversal from a downtrend to an uptrend. It's a strong bullish pattern that shows sellers have attempted multiple times to push the price lower but failed, indicating that buyers are gaining control. This pattern forms when price tests a support level three times but fails to break below it. This signals that sellers are running out of momentum and buyers are stepping in to drive prices higher. A valid triple bottom consists of four key parts. First, low, price moves down and hits a support level. Pullback, price bounces up but then comes back down for another test. Second low, price reaches the same support level but fails to break below. Third low, price makes one final attempt to break support but fails again, confirming buyer dominance. Once price breaks above the high between the three lows, the pattern is confirmed and an uptrend is likely to follow. A triple bottom is most effective when it forms at a strong support level after a clear downtrend. It signals that sellers have exhausted their strength, and buyers are ready to push the market higher. The head and shoulders pattern is one of the most reliable trend reversal patterns. It signals that an uptrend may be coming to an end and a potential downtrend could begin. This pattern consists of three peaks. Left shoulder, price rises and then pulls back. Head, price makes a higher peak, then drops again. Right shoulder, price moves up again, but forms a lower peak than the head, showing weakness. The key level in this pattern is the neckline, which connects the lows of the left shoulder and right shoulder. When price breaks below the neckline, it confirms the pattern and signals that sellers are taking control. There's also the inverse head and shoulders, which is the opposite, a reversal pattern that appears after a downtrend and signals a move to the upside. The head and shoulders pattern is easy to recognize and helps traders spot potential market reversals early. The inverse head and shoulders is the exact opposite of the regular head and shoulders pattern. It signals a potential trend reversal from a downtrend to an uptrend, showing that buyers are gaining strength after a period of selling pressure. This pattern consists of three lows. Left shoulder, price drops and finds support before bouncing up. Head, price makes a lower low but then recovers. Right shoulder, price moves down again but forms a higher low than the head, showing that sellers are losing control. The key level in this pattern is the neckline, which connects the highs of the left and right shoulders. When price breaks above the neckline, the pattern is confirmed, signaling a potential shift to an uptrend. The inverse head and shoulders is one of the easiest and most reliable reversal patterns, especially when it forms at key support levels after a long downtrend. Triangles are among the most common and easy to spot chart patterns. They form when price starts to consolidate, creating a tightening range that signals a potential breakout. Triangles help traders anticipate when a big move is about to happen. There are three main types of triangle patterns. An ascending triangle is a chart pattern used in technical analysis. It is created by price moves that allow for a horizontal line to be drawn along the swing highs and a rising trend line to be drawn along the swing lows. The two lines form a triangle. Traders often watch for breakouts from triangle patterns. The breakout can occur to the upside or downside. Ascending triangles are often called continuation patterns, since price will typically break out in the same direction as the trend that was in place just prior to the triangle forming. A descending triangle is a chart pattern used in technical analysis, created by drawing one trend line connecting a series of lower highs and a second horizontal trend line connecting a series of lows. A regular descending triangle pattern is commonly considered a bearish chart pattern or a continuation pattern with an established downtrend. However, a descending triangle pattern can also be bullish, with a breakout in the opposite direction, and is known as a reversal pattern. A symmetrical triangle forms when price creates both lower highs and higher lows, meaning that buyers and sellers are in balance, and the market is getting squeezed into a smaller range. This pattern doesn't have a clear bias. It can break out in either direction, depending on who gains control. The breakout direction determines whether the price will continue higher or lower. Alright, now let me show you how we can analyze the market using the concepts we've learned. Take a look at this Bitcoin daily chart. By drawing a support level here and a resistance level here, we can see that the market was ranging for a long time. When price moves sideways like this, it means buyers and sellers are in balance, and the market is in indecision. No one knows what's going to happen next. But then, we see a breakout. The market finally breaks out of the range and moves strongly to the upside. This tells us that buyers have taken control and the market is now in an uptrend. Here, the market tests this level twice, forming a support level, and then gets rejected, creating a resistance level. After a strong move upward, the market enters another range again, which means buyers and sellers are in balance, and at this moment, nobody knows what will happen next. Now, we wait to see what happens. If the market breaks above this resistance level, it indicates that the market is likely to continue moving up. If the market breaks below this range, it suggests that the market is likely to retrace and move down to retest this previous resistance level that has now turned into support. As you can see, with simple technical analysis concepts like trend analysis and support and resistance, we can analyze the market and anticipate its next move with confidence. Here is another example. This is the Solana daily chart. As you can see, the market was ranging for a long period of time, moving between this major support level and this major resistance level. Eventually, the market broke above resistance, indicating that price was likely to move higher. After this breakout, the market went up, but then retraced back to retest the previous resistance level, which had now turned into support. Once the market reached this level, it was rejected, forming a clear doji candlestick pattern. After the doji, price continued to move upward. For long-term investors, the best entry would be to wait for the market to retrace back to this support level again. Otherwise, entering a trade at these higher levels is considered a premium entry, which carries higher risk and could cost you money. As you can see, by using just trend analysis, support and resistance, and candlestick patterns, we can understand what happened to Solana, predict future moves, and even identify discounted entry opportunities. Many traders underestimate these basics, but once you master them, they give you a clear roadmap of price action, allowing you to analyze any chart with confidence. If you found this video helpful, make sure to like